Welcome back to Economic Insights. I'm Alex, and joining me as always is Selim, market veteran and the mastermind behind this show. Selim, I don't even know where to start this week. Silver crashing, tech stocks plunging, and something about AI making lenders very nervous.
Alex, this was the kind of week that reminds you why markets are humbling. We had historic precious metals volatility, a tech sector reckoning over AI spending that's rattling corporate credit markets, and central banks sending increasingly divergent signals. It's a lot to unpack, so let's dive in.
Okay, so take me back to Monday. Economic data was actually strong, wasn't it?
It was. We got a strong ISM manufacturing index reading, 52.6, highest since 2022, which initially pushed the S&P 500 near record highs. You would think the market would love good economic data. But here's the catch. When the economy looks strong, investors start questioning whether the Fed will actually cut rates. So Treasury yields jumped higher as rate cut expectations got priced out.
It's like the market can't decide what it wants.
Welcome to 2026. Good news is bad news if you're betting on rate cuts. Meanwhile, the Reserve Bank of Australia hiked rates by 25 basis points to combat persistent inflation. First major central bank to hike this year. But first we had the precious metals carnage.
I saw the headlines about silver. What actually happened?
Historic declines, Alex. Silver and gold saw extreme volatility, with silver plunging nearly a third in just 2 sessions before stabilizing. When you see moves like that in what's supposed to be a safe haven asset, you know something broke. It wasn't just retail panic. This was forced liquidations, margin calls cascading through the system, the kind of move that destroys levered positions overnight.
And gold got hit too?
Gold dropped, though not as violently as silver. Multiple factors converged. Higher treasury yields, reducing the appeal of non yielding assets, a stronger dollar putting pressure on commodity prices, and what looks like technical unwinding after a strong rally. The stabilization later in the week suggests this was more of a violent readjustment than fundamental shift, but it spooked a lot of people.
Then midweek, the tech sector imploded. What triggered that?
Two things. First, Anthropic, the AI company behind Claude, released a new AI automation tool. Investors looked at it and started questioning the entire business model of existing software companies. If AI can automate what these companies sell, why are we paying them subscription fees? Hence, brutal sell off in software stocks. But the real shock came from earnings. Alphabet reported revenues beating expectations, which normally would be good news. But they also announced capital expenditure plans of up to $185 billion for the year. That's more than the GDP of many countries, Alex.
That's just one company?
Just one. And then Amazon piled on later in the week with their own announcement. $200 billion in AI spending planned for 2026. We're talking about a combined spending tsunami from the big tech players.
Where does all that money go?
Data centers, AI infrastructure, chips, computing power. These companies are essentially betting hundreds of billions that AI will generate returns that justify this spending. But investors are looking at these numbers and asking the uncomfortable question, when do we actually see profits from all this investment? The revenue model is still murky.
So the market sold off on too much investment?
On uncertainty about returns. It gets worse. We now have data showing that four major US tech companies, Alphabet, Amazon, Meta, and Microsoft, forecast combined capital expenditure of approximately $650 billion for 2026. These historically capital light businesses are transforming into asset heavy operations. And to fund it, they're turning to debt markets in a big way.
They're borrowing this money?
Increasingly, yes. We're seeing a surge in blue chip bond issuance and complex asset backed loans. The market lost over $640 billion in value across these firms after the earnings reports. That's not a vote of confidence in these spending plans.
But then the jobs data came out and things got worse again?
Right. Late in the week, initial jobless claims spiked to an 8-week high, likely weather related, but still concerning. More importantly, job openings from the JOLTS data fell to approximately 6.5 million, the lowest level since late 2020 or early 2021. The ratio of job openings to unemployed persons dropped to below zero point 0.9. That's a significant cooling in labor demand.
So, after pricing out rate cuts on Monday, by Thursday the market was pricing them back in?
Exactly. Markets flipped the script. Weak labor data meant the Fed might need to cut more aggressively. Bitcoin also got destroyed during this period, dropping to a 15-month low. But then Friday happened.
The big bounce back?
Classic buy the dip action. The S&P 500 posted its best daily performance since May. The Russell 2000 small cap index surged. Battered tech stocks recovered ground, and Bitcoin reclaimed most of its losses, getting back to around $70,000. Volatility at its finest.
Let's dig deeper into the developed markets picture. What's the overall economic outlook?
The global composite PMI rose to 52.5 in January, so we're seeing acceleration in activity. Global GDP is projected to grow at an above potential rate, driven largely by consumer resilience. But the inflation is rotating geographically. The US is expected to run above 3% inflation, while Europe is moderating toward or below target. That means central bank policies are diverging significantly.
Let's break down the US data. That manufacturing number was really strong, right?
Very strong. ISM manufacturing hit expansion territory, first time since late 2022, and it beat consensus expectations. The drivers were broad based. New orders jumped nearly 10 points, and production rose roughly 5 points to a level we haven't seen since mid 2022.
What about inventories? Does that matter?
Manufacturing inventories look lean. The customer inventories index fell to 38.7, which is a level we associate with tight post pandemic supply conditions. This suggests potential pressure for restocking, and given the state of US manufacturing, that likely means imports. Input price pressures remain elevated, but have moderated compared to mid 2025 peaks. The prices index edged up to 59.0.
And services?
ISM services held at 53.8 in January. Solid conditions. The components were mixed. Business activity strengthened, but new orders softened and employment decreased slightly. But here's the concerning part. Unlike manufacturing, price pressures in services showed no sign of easing. The prices paid index rose to 66.6. That's the sticky inflation the Fed is worried about.
Speaking of the Fed, what are they thinking right now?
Well, Kevin Walsh's nomination for Fed chair is influencing market expectations. His views favor a smaller balance sheet and potentially a steeper yield curve. While the base case for 2026 is evolving towards no rate cuts, the distribution of outcomes suggests risks are tilted toward a sharper easing cycle if labor data continues to deteriorate.
Let's talk about those labor market numbers you mentioned. How bad is it really?
Job openings fell to about 6.5 million in December, lowest since late 2020 or early 2021. The labor market is characterized as low fire, low hire. The quit rate remained flat. People aren't leaving jobs, but employers aren't hiring either. Private employment expanded only 22,000 in January. That's after a downward revision for December. Analysts caution that recent methodological changes to ADP have resulted in low correlation with BLS data, so take it with a grain of salt.
Any other concerning signs?
Announced job cuts in January reached 108,000, highest for the month since 2009. Some of that skewed by specific cuts at UPS and Amazon. But here's the striking detail. Artificial intelligence was cited as the reason for 7% of total cuts in January. The AI revolution isn't just changing business models, it's actively reducing headcount. AI is real. You are replacing humans, Alex.
Yes, I am. Shifting to the UK, the Bank of England meeting was significant.
This was the story of the week for UK markets. The BOE kept rates at 3.75%, But here's the critical detail. The vote split was 5 to 4 to hold, with 4 members voting for an immediate cut. That's a significant dovish shift. Catherine Mann, traditionally considered a hawkish member, explicitly noted that new analysis has brought the appropriate time for a rate cut closer. That's a departure from her previous stance.
What did Governor Bailey say?
Bailey adopted a dovish tone, stating he'll approach upcoming meetings asking whether a cut is justified. He explicitly noted that market pricing implying a 50-50 chance of a cut in March was not a bad place to be. That's as close as you get to forward guidance without actually committing. Following the meeting, analysts have strengthened their conviction for a March cut. The BOE's forecasts show inflation returning to the 2% target by Q2 2026, sooner than previously projected. They're even forecasting an inflation undershoot in 2027 and 2028, suggesting current policy settings may be too restrictive over the medium term. The BOE is clearly getting uncomfortable with keeping rates this high.
And the ECB
The ECB kept rates on hold as expected. They could have just emailed us the meeting outcome.
and Japan?
Japan's in an interesting spot. Market expectations for a rate hike in April have increased significantly, with some possibility of a move in March. Election is on February 8th, and polls suggest the LDP coalition will retain a majority. The domestic banks have been realizing losses on bond portfolios, but have offset them so far with equity gains.
You mentioned earlier that tech companies are turning to debt markets to fund their AI spending. How big of a deal is this for credit markets?
It's massive, and it's creating anxiety in ways that might not be obvious. High grade and high yield credit spreads have widened recently, driven specifically by the sell off in the software sector amid fears of AI disruption. This isn't just about equity prices, it's about creditworthiness.
Walk me through that connection.
Here's the problem: private investment firms have enormous exposure to the software industry. Software companies account for approximately 17% of borrowers in the private credit universe, representing over $220 billion in debt exposure. That's $250 billion in loans to an industry that's now facing an existential question about its business model.
Because of AI tools like the one Anthropic released,
Exactly. The traditional view was that software companies are safe borrowers. They have predictable subscription revenue, high margins, sticky customers. But now lenders are asking, what if AI powered competitors can displace these incumbents? What if customers start canceling subscriptions or demanding fee reductions because AI can do the work cheaper? And we're already seeing signs of stress in leveraged loans to software companies. If the revenue projections based on subscription business models sour, you've got a problem.
are the lenders panicking?
Not yet panicking, but the market isn't entirely convinced and is getting defensive, hence the widening spreads.
And the big tech companies issuing all this debt to fund AI? That's a separate concern?
It's related but different. These are blue chip credits. Alphabet, Amazon, Meta, Microsoft, they have strong balance sheets and can access debt markets at favorable rates. But they're fundamentally transforming from capital light businesses to asset heavy operations. One major tech firm has seen its property and equipment assets increase fivefold since 2019. That's a massive shift.
What's the risk there?
The risk is that they're borrowing hundreds of billions to build infrastructure that may not generate the returns they're projecting. If AI monetization proves harder than expected, you've got companies with massive debt loads and stranded assets. The $640 billion market value loss we saw this week suggests investors are pricing in that possibility.
So we have software companies worried about AI destroying their business, and tech giants borrowing to build AI infrastructure that might not pay off.
This is the paradox of 2026. The companies building AI are betting everything on it, while the companies AI might displace are seeing their credit quality questioned. It's a massive reallocation of capital happening in real time, and credit markets are trying to price the uncertainty.
All right, let's circle back to commodities because that precious metals move was just insane.
Alex, this was legitimately historic. Silver plunged nearly a third in just 2 sessions. We're talking about moves you normally see in meme stocks or crypto, not traditional safe haven assets. When silver crashes like that, it's not just sellers, it's forced liquidations, margin calls creating a cascade effect, and sheer panic.
What were the fundamental drivers?
Multiple factors converged. Higher treasury yields and a strong dollar put pressure on commodity prices denominated in dollars. And you had a technical unwind. These markets had run up, positioning got crowded, and when the selling started, it accelerated. The recovery and stabilization later in the week suggests this was a violent adjustment rather than a fundamental shift in the precious metal story.
Gold got hit too, but not as badly?
Gold dropped but held up better than silver. Interestingly, there's still strong underlying demand. Central banks are continuing to accumulate gold. The pullback is being characterized as a healthy correction within a longer term rally.
What about silver specifically? Why did it get hit harder?
Silver has more two sided risks. About 60% of silver usage is industrial demand, which faces pressure from substitution trends. In solar panel production, for example, high prices have accelerated the shift to alternative materials. And unlike gold, you don't have central banks backstopping demand. So when the selling started, there was less of a floor.
What about currencies?
The dollar strengthened on the stronger US economic data and higher treasury yields. Emerging market currencies generally weakened, though we'll get into specifics. The Australian dollar initially strengthened on their rate hike. The pound had an interesting week on the dovish BOE signals.
Let's get to emerging markets. India seems to have made the biggest headlines this week.
India was definitely the standout. Two major developments. First, the US and India signed a significant trade deal on February 2nd. They reduced reciprocal tariffs to 18% and removed punitive duties, conditioned on India scaling back Russian oil imports.
What does that mean for India's economy?
Growth forecasts are being revised higher. The deal particularly benefits labor intensive sectors like textiles, gems and jewelry, and pharmaceuticals that were previously facing a 50% tariff threat. It's expected to narrow India's current account deficit and significantly reduce trade policy uncertainty.
And the Reserve Bank of India meeting?
The RBI held its repo rate at 6% with a neutral stance. But here's the interesting part. They cut the cash reserve ratio by 50 basis points to 4%. That injects liquidity into the banking system without cutting the main policy rate,
Why not just cut rates?
because inflation, while moderating, is still a concern. By cutting the CRR, they're supporting growth through liquidity rather than through price. It's a clever balancing act.
What about Turkey? Inflation is still a concern.
Turkey's January CPI came in hotter than expected, 4.8% month over month. Headline inflation actually eased slightly to 30.7% year over year from 30.9% in December. So monthly pressure, but the year over year trend is still improving.
So is that good or bad?
Mixed. The seasonally adjusted reading is expected around 2.9% month over month, which would be the highest monthly print since January 2025. That's concerning. But core inflation declined to 29.8% year over year. The underlying trend is disinflationary, but the monthly bumps create extreme volatility.
How did markets react?
Delayed but fierce reaction. Turkish bonds sold off hard. Investors who were betting on aggressive rate cuts are now reconsidering. The big question now is whether the CBRT continues its easing cycle or pauses given this inflation print.
China? Anything major happening?
Relatively quiet week for China, which after recent volatility is actually welcomed. The main headline was the soybean purchase commitment from the Trump Xi call. Looking ahead, China's January inflation data is due next week. Still deflationary pressures, but moderating.
South Africa, Egypt, Mexico?
South Africa was caught up in the metals volatility. Egypt has its central bank meeting Thursday next week, and analysts are expecting a 100 basis point cut. Egyptian bonds have been offering attractive yields for those willing to take the risk. In Mexico, Banxico held rates at 7%, but signaled cuts could resume soon. They're in pause mode to assess the impact of recent tax and tariff hikes on the inflation outlook. The peso has been holding up well. which helps contain merchandise inflation, though services inflation remains persistent.
When do they expect to start cutting?
Analysts expect cuts to resume in the second quarter, May or June, independent of what the Fed does. Some see a path toward a terminal level of 6.25%. Others project two consecutive 25 basis point cuts to reach 6.5%. The fiscal situation is concerning, though. Public sector deficits for 2025 were reported at 4.8% of GDP, higher than the budgeted numbers.
So what's coming up next week? Sounds like it's going to be intense.
Massive week ahead, Alex. It's a double feature for US data because of earlier reporting delays. We get the January jobs report on Wednesday and the January CPI on Friday. This could be pivotal.
What are expectations for the jobs report?
Forecasts are for non-farm payrolls to rise by 65,000 to 75,000, with unemployment holding at 4.4%. After this week's weak JOLTS data and the spike in jobless claims, the market is nervous. A weak number could really shift Fed expectations. There's also risk of a significant downward benchmark revision to employment levels.
And inflation?
Analysts are forecasting core CPI to accelerate to 0.34% to 0.39% month over month. There's something called residual seasonality, start of year price resets, and contract renewals that historically boost January readings. Specific upside pressures are cited from core goods due to gradual tariff pass through and a rebound in used vehicle prices, plus strength in non shelter services like airfares. Risks are generally viewed as tilted to the upside. Also, Tuesday brings retail sales for December, expected to rise 0.4%, reflecting solid holiday spending. UK fourth quarter GDP on Thursday, China inflation Wednesday, India CPI Thursday, and that Central Bank of Egypt meeting I mentioned with the expected 100 basis point cut. The Japan election will be particularly interesting. We also have some notable corporate earnings.
Well, Selim, another absolutely wild week. Thanks for walking us through all of it, especially that credit market analysis. That was eye-opening.
Always a pleasure, Alex.
Don't forget, folks, we do not give investment advice. For that, please consult a professional. We'll see you next week with the big jobs and inflation reports.